Economic update, asset allocation, meeting summary, United States monetary policy and Federal Reserve outlook. MAV opened the discussion by noting that the March Federal Open Market Committee FOMC meeting produced no change to interest rates, an outcome that had been broadly anticipated. He observed that a call for a 25 basis point cut, attributed to Stephen Mirren, was never expected to succeed. MAV highlighted that the Fed's dot plot projections were likely to be among the least informative ever published, given the profound uncertainty introduced by the escalating Middle East conflict. Notably, the Fed's core personal consumption expenditure, PCE, forecast for 2026 was revised upward significantly, from 2.4% at the December meeting to 2.7%, against a current reading of approximately 2.8%. MAV expressed skepticism that the Fed's stated 2% inflation target reflects its true policy objective, suggesting that its conduct of monetary policy implies an effective target closer to 2.5%. Market pricing for rate expectations had shifted materially. Whereas traders had previously anticipated at least 2 and possibly 3 cuts by year-end, the most recent positioning, captured approximately 1 hour prior to the meeting, implied only half a cut by Christmas, a significant repricing in a short period. The Fed's dot plot still indicated one further cut, though MAV noted the market no longer credited this projection. He assessed the neutral rate to be in the high threes, having revised it down modestly from a previous estimate of approximately 4%, reflecting expected AI-driven productivity gains and softer labour market conditions, though acknowledging the Middle East conflict had complicated this assessment. MAV also noted that Federal Reserve Chair Jerome Powell, whose term is approaching its end, had indicated his intention to remain as a Fed official during the transition period, particularly while Department of Justice investigations and scrutiny of Governor Lisa Cook are ongoing, and pending the confirmation of Kevin Walsh as his successor. Turning to US inflation data, MAV reported that headline CPI on a not seasonally adjusted basis stood at 2.4% year-on-year, though he raised the possibility that the government shutdown and an unusually cold weather period in January and February may have temporarily suppressed this figure. The seasonally adjusted annualized quarterly CPI had returned to 3%, and producer price inflation, PPI, was rising sharply. He noted an unusual circumstance in which core PPI was running above headline PPI, a configuration he had not observed for some time, with implications for forthcoming PCE readings, which he anticipated could surprise to the upside. The trimmed mean for PCE had been trending downward, though MAV questioned how much longer this could persist. On the labour market, he noted US unemployment at 4.4%, cautioning that this figure would be materially higher, closer to 5%, had the participation rate not declined by approximately half a percentage point and had net overseas migration not effectively ceased. GDP growth on a year-on-year basis was approximately 2%, with a quarter-on-quarter reading of 0.16%, which MAV attributed substantially to the government shutdown rather than underlying economic weakness. He anticipated a rebound once that temporary detractor reversed. Goldman Sachs chief economist Jan Hatzius presented in Melbourne prior to this meeting, and MAV shared several observations from that presentation. Goldman Sachs projected a strong first half of 2026, driven primarily by a substantial fiscal impulse from the One Big Beautiful Bill Act, with positive financial conditions also expected to contribute. However, MAV noted that financial conditions were likely to be neutral at best going forward, particularly as credit spreads had begun to widen. The tariff effects were projected by Goldman Sachs to fade entirely by the fourth quarter of the current year, with no measurable impact apparent by that point. MAV also observed that the US personal savings rate stood at approximately 4.5%, below the low sixes average recorded between the global financial crisis and COVID-19, and that absent fiscal stimulus the US economy may have encountered difficulty. Kingsley Jones noted that the US 10-year Treasury yield appeared surprisingly steady given the severity of the inflation risk, a point he found noteworthy. Stephen Duchesne flagged that credit spreads more broadly had been widening, consistent with increasing stress in private credit markets. Bloomberg's recently resumed Orange Book, an analogue to the Fed's Beige Book, was also cited by Mav as providing broadly positive readings on activity and margins prior to the onset of the Middle East conflict, though he cautioned this could reverse quickly. Geopolitical risk, Middle East conflict and commodity implications. The Middle East conflict dominated the geopolitical discussion, with Mav, Jones, and Duchesne all contributing substantive assessments. Mav framed the conflict as a key source of macro uncertainty, noting that oil prices had reached approximately $99 per barrel for West Texas Intermediate and $110 per barrel for Brent crude at the time of the meeting. He outlined a range of scenarios, including one in which oil reaches $120 per barrel and a more severe scenario at $150 per barrel, which he described as potentially disastrous, capable of rendering current economic projections obsolete and materially increasing the probability of a stagflationary outcome. Jones elaborated on the commodity dimensions of the conflict, highlighting that approximately 20% of global oil supply transits the Strait of Hormuz. He introduced a less discussed but highly significant dimension. Approximately 45% of global urea supply, a critical agricultural fertilizer, originates from the Gulf region. Australia is particularly exposed, with approximately 70% of its urea imports sourced from that area. Jones noted that this had already manifested in rising Producer Price Index (PPI) readings, and that the timing was especially concerning given that Europe and the United States were approaching spring planting season, while Australia faced its own winter cropping cycle. He connected this to broader concerns about diesel supply and food chain disruptions. Jones additionally noted that Gulf states, which had tacitly supported Iran to varying degrees over the preceding 5 to 10 years, now felt deeply aggrieved following Iranian missile strikes on their facilities, including reported damage to a Qatari LNG plant. Mav noted that attempts had also been made to target Saudi Arabian infrastructure. Jones observed that the stocks with positive agricultural fertilizer exposures had so far experienced only modest price appreciation, suggesting that markets had not yet priced in the full risk. Kingsley Jones offered a detailed strategic assessment of the military geography underpinning the conflict. He expressed skepticism about prevailing assumptions that US and Israeli military dominance would guarantee a swift resolution, drawing parallels to the Suez Crisis, 1956, the Yom Kippur War, and the Vietnam War, including Operations Linebacker 1 and 2 and the Cambodian bombing campaign, where superior military force did not produce the desired strategic outcome. Jones noted that reportedly credible wargaming exercises consistently concluded in defeat for the US when attempting to open the Strait of Hormuz, attributing this to geographic constraints rather than military capability. He pointed out that harassing shipping through the strait requires only a small mobile force, and that ships passing through would be effectively uninsurable regardless of military presence. Jones also noted that the Houthis had reportedly signaled plans to restart operations to close the Red Sea. He flagged reporting in the Australian Financial Review, suggesting it was Israel that initiated attacks on Iranian gas fields, which he assessed as having precipitated Iranian counterstrikes on Qatar, raising questions about when and whether Israel would choose to de-escalate. Jones drew an analogy between Iran's reported Mosaic command structure, wherein units act on sealed orders independent of central communication, and the organizational resilience demonstrated historically by both the IRA and the Viet Cong. Mav and Jones jointly cautioned that 3 weeks of conflict was insufficient to generate meaningful demand destruction, but that 3 months could be. Jones noted that China, Japan, and South Korea, Australia's 3 largest export trading partners in that order, were all heavily energy price dependent, raising questions about how long the Australian dollar could sustain its current level in the face of potential demand deterioration. Mav described the situation as one in which any further escalation would render all current economic projections unreliable. Australian monetary policy, interest rates, and domestic economic conditions. Mav reported that the Reserve Bank of Australia's RBA most recent meeting had produced a 25 basis point interest rate increase. It is noted that Mav initially misspoke by saying cut before immediately correcting himself. Passed on a split 5-4 board vote. Governor Michelle Bullock characterised the decision as one of timing rather than direction, asserting the board had always intended to hike. However, Mav observed that the split decision had unsettled markets as to the board's unity on inflation management, and that Bullock's framing was not universally accepted. Deputy Governor Hauser, described as British, had given an interview to the Conversation on the ABC in the period immediately preceding the meeting, in which his remarks were assessed by Mav as skewing hawkish, referencing the risk of inflation expectations becoming de-anchored. Mav noted that at one point the market had priced in 3 rate hikes for the year. Following the split vote, roughly one of those hikes was priced out, leaving the market expecting one further hike by approximately August, with the third hike now in doubt. Australian 10-year government bond yields were reported at approximately 4.95%, with the US 10-year at approximately 4.25% and Japan at approximately 2.2%. The Australian dollar was trading at approximately 70 US cents, benefiting from rising LNG prices, notwithstanding that many Australian LNG contracts are locked in at fixed long-term rates. Mav noted that Australia's long-term real interest rate had reached 2.5% for the first time in a considerable period, and expressed doubt that the Australian economy could sustain that level for any meaningful duration. He indicated that if the 10-year yield were to settle around 5% with inflation remaining elevated, the macroeconomic consequences for Australia would be unfavourable. US 10-year break-evens were cited as remaining below 2.4%, with real rates below 1.9%. In terms of domestic economic activity, Australian GDP per capita had improved modestly, though remained below 1% year-on-year, which Mav described as deeply disappointing for Australian households. The December quarter GDP figure came in above expectations, though he attributed much of the strength to inventory rebuilding in iron ore and coal rather than underlying demand. Private consumption remained the primary contributor to quarterly GDP, though Mav expressed concern about its composition, noting that public consumption, encompassing programs such as the National Disability Insurance Scheme and various federal and state government expenditure programs, was the dominant driver, effectively crowding out private sector activity. Gross national expenditure, absorption, defined as consumption, investment, and government spending excluding exports, had been strengthening and was contributing to domestic price pressures. Nominal GDP, which incorporates the GDP deflator, had returned to approximately 6%, near its long-term average. Jones noted as a tentative positive that productivity growth had reached approximately 1%, though Mav expressed uncertainty about its sustainability, attributing it in part to workers being compelled to increase effort rather than structural improvement. Private credit markets, AI disruption, and broader financial stability risks. Duchesne provided a detailed briefing on developments in private credit markets, with particular focus on US business development companies, BDCs, publicly listed entities that lend primarily to small and medium-sized private companies, with a heavy concentration in technology-related businesses. BDCs have attracted significant publicity over the preceding 12 months. Structurally, BDCs lend in both debt and equity instruments, and if they distribute 90% of their revenues, they are effectively tax-exempt, a feature Duchesne likened to the REIT structure. He noted that BDC net asset values had been declining and that investor demand for redemptions had increased dramatically as illustrated by Financial Times data cited in the meeting. Importantly, Duchesne flagged that the redemption volumes charted in the Financial Times were running above the 5% quarterly threshold that many evergreen private credit structures offer as standard liquidity terms, meaning the excess redemption demand would carry over into subsequent quarters, with the risk of a self-reinforcing run dynamic as remaining investors rush to exit ahead of further constraints. Mav separately noted that in Australia, Realm's Strategic Income Fund had encountered difficulties apparently related to a fraud in one of its UK private credit exposures, and that Wise Owl had been unable to meet its initial redemption window. Though he described the revised arrangements as satisfactory, he acknowledged that broader credit spreads had been widening, though stopped short of characterising the situation as systemic, noting no specific evidence of widespread credit deterioration at that stage. The discussion clarified, in response to a question from Brad Bugg, that BDCs lend directly to private companies and do not participate in the corporate bond market, and therefore are not on the buying side of large-scale bond issuances by entities such as Oracle for data center funding. Duchesne suggested that the BDC situation could serve as an early warning indicator for corporate credit stress that is otherwise difficult to observe, given the bilateral and non-public nature of many corporate credit arrangements. On AI-driven labour market disruption, Goldman Sachs's baseline projection, as conveyed by Mav, was that AI displacement of workers would be moderate and would play out over a 5 to 10-year horizon. However, the presentation noted that the key risk to this forecast was faster than expected adoption, represented in Goldman Sachs's modelling by a light blue scenario line rising well above baseline. Mav cautioned that Goldman Sachs's analysis was based on gross labour market outcomes rather than net, and offered to distribute the document subject to permission. Duchesne strongly disputed the Goldman Sachs baseline, asserting that everything he observed pointed toward rapid adoption and accelerating displacement. Citing first-hand experience of replacing software developers with AI coding tools such as Claude Code within his own investment businesses. He raised the prospect that rising corporate profitability from AI productivity gains would draw political pressure for higher corporate tax rates as governments sought to offset declining personal income tax revenues. Mav and Jones both highlighted the risk of displacement concentrating among median white-collar workers, a view consistent with commentary attributed to Hamish Douglas in a Melbourne radio interview. The prospect of a universal basic income as a policy response was raised, particularly for workers such as those in their mid-50s who had spent careers in computer-based roles and for whom retraining in trade occupations was likely impractical. Jones raised the potential for early-stage technology companies, heavily represented in venture capital and private equity portfolios, to come under significant valuation pressure, characterising them as a potential canary in the coal mine, with insolvencies in Australia continuing to rise. It is noted that while multiple participants expressed views on the pace of AI adoption, no specific quantitative data from the Goldman Sachs presentation on displacement rates or unemployment projections was disclosed in sufficient detail to report precise figures. Pendal Group, Australian large cap reporting season wrap. Earnings revisions and market dynamics. Jim Taylor of Pendal Group opened the presentation with an analysis of earnings movements across the ASX over the period from the start of September 2024 through to the first week of March 2025. Taylor noted that over this period, the ASX 200 delivered a net price movement of negative 4%, decomposed as positive 8% earnings growth, offset by a negative 12% valuation contraction. He attributed the valuation compression primarily to a material shift in interest rate expectations, whereby the market transitioned from anticipating a rate-cutting environment to pricing in a rate-rising cycle, driven by persistently sticky inflation. Taylor further noted that more recent geopolitical developments, captured within the final week of the measurement period, also contributed to the valuation decline. Taylor emphasised that the breadth of positive earnings revisions across the reporting season was notably broad, spanning financials, resources and industrials. In terms of forward-looking EPS revisions emerging from the reporting season, Taylor indicated that the proportion of stocks receiving upgrades was the highest recorded in several years, whilst the proportion receiving downgrades, though marginally above the long-term average, remained amongst the better outcomes observed across recent reporting seasons. On a sector basis, metals and banks registered the most significant positive EPS revisions over the course of February, with banks delivering approximately 8 to 9% relative outperformance versus the broader ASX during the period. Conversely, sectors with negative EPS revisions of -1 to -2% experienced disproportionately large share price declines, illustrating the increasingly punitive market response to even modest earnings disappointments. Taylor noted that approximately 20% of stocks moved plus or minus 10% on their reporting day, a figure that has approximately doubled over recent years, with the downside amplitude in particular rising materially. He also highlighted that individual stock dispersion has exceeded levels observed during both the GFC and COVID periods, despite the overall index remaining comparatively stable. Banking sector outlook. Taylor provided a detailed assessment of the Australian banking sector, noting that net interest margins experienced significant compression during the period from June 2022 to June 2023, driven by irrational mortgage price competition, with ANZ and Westpac cited as particularly aggressive participants during that period. Since June 2023, Taylor observed that margins have trended on a gentle upward trajectory, supported by a subsidence in mortgage competition, strong credit growth of approximately 6 to 8% across both business and mortgage lending, and the bank's reluctance to fully pass through the prevailing rate environment to deposit holders. Taylor drew attention to a material dislocation between bank earnings per share growth and share price performance over the past 2 years, with bank share prices significantly outperforming their underlying EPS trajectory. He attributed this in part to portfolio rebalancing by large domestic industry funds and covering of underweight positions by domestic fund managers. Taylor noted that bank price-to-earnings multiples are currently elevated at approximately 21 times, and expressed the view that these multiples are likely to compress as the economy responds to rate hikes already implemented. He cautioned that credit loss provisions are currently being recognised at historically low rates through the profit and loss statement, and that whilst a severe bad debt cycle is not specifically forecast, this represents a meaningful risk to the earnings outlook. Taylor noted that the banks are proving relatively defensive in the current geopolitically uncertain environment, though he expects PE compression to occur once conditions normalise. Individual stock assessments. Taylor provided commentary on several individual securities. On QBE Insurance, Taylor noted the company is trading at approximately 10 to 11 times earnings and highlighted a divergence between the claims ratio being reported through the profit and loss statement and the actual net cash claims ratio being experienced, with the gap representing conservative provisioning by the current management team. Taylor expressed the view that QBE does not require a continuation of the strong premium cycle to deliver positive outcomes, given the degree of conservatism embedded in current provisions. The broader insurance sector observation was that commercial insurers are being derated on 2 bases: an anticipated end to the positive premium pricing cycle and the potential for AI-driven disruption. On Light & Wonder, Taylor noted the company has recently transitioned its listing from the United States to the ASX, and that it has materially increased investment in game development and executive talent over recent years, resulting in it achieving number 1 or number 2 market positions across its key competitive segments. Taylor indicated that free cash flow is expected to approximately double over the next 3 years from FY24. And that the company recently acquired the Grover business in the charitable gaming segment, an acquisition described by the company's chairman as performing ahead of expectations. Taylor expressed the view that the current double-digit PE represents excessive discounting of the impact of a potential slowdown in US rate cuts on the consumer, and that the stock is materially undervalued. It is noted that the precise current PE figure was described only as double-digit, without further specificity. On BHP, Taylor described the result as a standout for the reporting period, highlighting disciplined cost control and a strategically significant transaction in which BHP sold the silver production stream from its Antamina mine, in which it holds approximately a mid-30% interest, to a North American royalty company for $4.3 billion US. Taylor noted that most market participants had valued BHP's entire stake in the Antamina mine at approximately $5 billion US, making the silver stream transaction alone a material surprise. This transaction, alongside the sale of smaller mines and a partial divestment of BHP's Western Australian power business, is expected to contribute approximately $10 billion US in non-core asset sales. Taylor further noted that BHP has flagged a targeted 40% increase in attributable copper production by the mid-2030s, with the FID for the Vicuña mine materially accelerated ahead of prior market expectations. Artificial intelligence and technology disruption. Taylor drew on observations from a 10-day visit to San Francisco and the broader west coast of the United States, during which he met with software companies, startups, NVIDIA, and various semiconductor businesses. Taylor's primary assessment was that the de-rating of software stocks is partially justified, reflecting both elevated starting valuations and a potential compression of terminal growth rate assumptions, though he noted that actual EPS growth across US software companies in the most recent reporting season was approximately 17 to 20%. Indicating disruption has not yet manifested in reported earnings. Taylor observed that demand for data center compute capacity remains in significant excess, driven by both cloud and enterprise workloads, as well as the transition from model training to inference workloads. He noted that recent iterations of large language models, specifically citing upgrades to Claude and Claude Code at the back end of calendar year 2025, represented a step change in model efficacy and are expected to drive increased volatility in upcoming reporting seasons as professional investors deploy these tools for real-time earnings interpretation and analysis. Taylor expressed skepticism regarding headline AI-driven headcount reductions announced by companies such as WiseTech and Block, the latter of which announced an approximately 40% reduction in headcount, with AI cited as a contributing factor. Taylor noted that WiseTech had recently completed a large acquisition that had underperformed, making it a candidate for cost reduction independent of AI productivity gains, and that Block's headcount had tripled over the preceding 7 to 8 years, similarly providing structural scope for rationalization unrelated to AI. Taylor was unequivocal in his view that AI-driven productivity gains are, at present, largely confined to software engineering functions and are not yet manifesting in broad-based industrial or financial services employment. He further noted that agentic AI adoption within large enterprises faces significant barriers, including sales cycle lengths of 6 to 9 months, and enterprise concerns regarding data security and privacy. Taylor identified companies with proprietary, non-scrapable first-party data, citing REA Group and FactSet as examples, as better positioned to withstand AI-driven competitive disruption. On the private capital side, Taylor observed that venture capital and private credit flows into software startups have materially dried up over the preceding month, driven by fund redemptions, which he assessed as a net positive for incumbent listed technology companies by slowing the pace of competitive scaling from well-funded challengers. Ely Griffiths Group, Australian Small Cap Reporting Season, Asset Allocation Meeting Summary. Section 1. Reporting Season Overview and Key Sector Observations. Ben Griffiths opened by characterising the February reporting season as one that broadly exceeded expectations, notwithstanding pre-season pessimism from certain market commentators. Griffiths noted that FactSet recorded a beats-to-misses ratio of 2.4 times across the universe, which he regarded as a healthy outcome. The dominant theme of the season was margin improvement rather than top-line revenue growth, with Griffiths cautioning that whilst markets responded favourably to margin expansion in the short term, sustainable business growth ultimately requires durable top-line expansion. Defensives and domestic cyclicals were identified as the standout performers for the December half, whilst growth-oriented names broadly disappointed. Among the most notable sector observations was the performance of the Australian banking sector. Griffiths reported that 3 of the 4 major listed banks traded to all-time highs during the period, with CBA being the sole exception, having already established its record high prior to the reporting season. Key metrics underpinning the bank's strong results included loan growth that exceeded analyst expectations, pronounced cost reductions, expanding net interest margins, and asset quality that deteriorated far less than anticipated. Griffiths described the outcome as exhibiting positive operating leverage, or positive jaws, characterised by improving revenues alongside declining costs. Smaller non-bank financial institutions, including Judo Bank and Own Home, also delivered creditable results. Griffiths noted that the banking sector remains broadly underowned among major institutional investors and is a frequent target of short sellers, making its strong price performance particularly notable. Conversely, domestic consumption represented a clear weak spot. Retail stocks, despite largely beating consensus estimates, were met with an unfriendly market reception. Griffiths attributed this to cautious or negative trading updates accompanying results, particularly among housing-exposed retailers. Specific companies cited as experiencing share price weakness following their results included Nick Scali, Temple & Webster, Beacon Lighting, and Harvey Norman, each of which Griffiths noted succumbed to selling pressure post-reporting. The spectre of further interest rate increases, with the market at the time of the presentation pricing in a possible rate hike in May, was identified as a material dampener on consumer sentiment and retail valuations. Section 2. Infrastructure, AI classification, and investor positioning dynamics. Griffiths identified non-residential construction and infrastructure as a significant positive theme during the reporting season, noting that the major project pipeline, defined as projects with capital expenditure budgets in excess of $500 million, is at capacity. Of particular note, ANZ Bank released observations during the reporting period indicating that it had extended its forecast for peak infrastructure spend from the current year out to 2028. ANZ also made the claim that private sector infrastructure investment is now growing at a faster pace than public sector investment, which Griffiths noted was the first such occurrence in approximately 5 years. Companies with direct exposure to this pipeline that reported strongly included Saunders International in road construction, Parenti in light and heavy engineering, NRW Holdings in civil contracting and roadworks, and Downer. Additionally, companies with expertise in electrical and data center engineering, specifically ACE, Genius Plus, SKS, and Maca Group, performed well, with Griffiths noting that the latter's result was partially obscured by a previously announced corporate reorganisation. Griffiths also highlighted Macquarie's work in disaggregating ASX-listed companies by their relationship to artificial intelligence, noting this was the first reporting season in which such a classification had been formally applied. According to Macquarie's analysis, 21% of ASX-listed companies were classified as AI enablers, 51% as adopters or adapters, 6% as disruptors, and 22% as neutral. Griffiths noted that enablers broadly beat guidance and upgraded earnings expectations, whilst those classified as disruptors largely downgraded their numbers. On the matter of investor positioning, Griffiths used Zip Money as an illustrative case study. Despite reporting an outlook that Griffiths characterised as far from catastrophically negative, acknowledging rising bad debts, the stock fell 34% on its result day. More remarkably, 20% of the company's total issued shares traded on that single day, equating to just under $500 million in turnover, making Zip the third largest traded stock on the ASX that day, behind BHP at approximately $750 million and CBA at approximately $650 million. Griffiths noted that even a subsequently announced $50 million share buyback failed to arrest the decline on the following day, underscoring positioning rather than fundamentals as the dominant driver of outsized price reactions during the reporting season. Section 3. Earnings trajectory, guidance metrics, and market outlook. Griffiths presented Macquarie data indicating that guidance surprises were overwhelmingly positive during the season, with actual guidance correlated to two-day share price returns at approximately 52%, far ahead of the next most influential factor, dividend surprises, at approximately 20%. In terms of guidance revisions, 45% of small industrial companies upgraded guidance versus approximately 26% of ASX 100 companies. Approximately 48% of small industrials maintained guidance, with downgrades remaining in the minority. Despite this, the two-day share price reaction to downgrades was severe and consistent across market capitalizations, averaging approximately a 17% decline regardless of company size. Notably, upgrades among small industrials produced a largely neutral share price reaction over 2 days, with only modest appreciation observed within the ASX 100. Griffiths presented data showing that, for the first time in 3 years, the Australian share market is recording positive earnings growth. FY25 and FY24 both concluded with approximately negative 5% earnings growth, with FY23 also negative. FY26 earnings growth was upgraded by approximately 230 basis points to 10.6%, driven primarily by resource stocks and banks. FY27 earnings expectations have been modestly trimmed, though Griffiths cautioned this estimate remains subject to substantial revision. For context, Griffiths cited Goldman Sachs forecasts for the US market of approximately 15% earnings per share growth for the current year and approximately 17% for the following year, noting the US market has sustained strong earnings growth for a considerable period. Griffiths also discussed the equity risk premium, which he calculates independently and cross-references against Goldman Sachs's methodology, incorporating earnings yield, payout ratio assumptions, GDP growth, inflation, and the 10-year bond rate. He noted the premium currently sits at approximately 2.9%, having recently traded below 2%, and observed that historically a reading below 3% has tended to precede market corrections. Mav and Kingsley Jones both queried the source of this metric, prompting Griffiths' explanation of his methodology. Griffiths noted that the prevailing tolerance for a thin equity risk premium is partly supported by the strong US earnings growth outlook. The AAII Investor Sentiment Survey was cited at 31% bullish at the time of the presentation, with Griffiths noting that historical bottoms in investor confidence tend to occur around 26%, which has traditionally served as a contrarian buy signal. Section 4. Portfolio positioning, labour market conditions, and the Australian dollar. Griffiths outlined the current positioning of the Ely Griffiths Small Companies Fund, noting a materials overweight of approximately 32% against a benchmark of 28%, of which approximately 12.5% is allocated to gold, with the remainder spread across base metals and bulk commodities. Consumer discretionary remains slightly overweight, though Griffiths indicated the fund is actively trimming where appropriate. Real estate investment trusts are underweighted, with Griffiths noting the REIT benchmark has declined approximately 25% from its September highs as a consequence of rising bond yields, characterising REITs as poor man's bonds. Cash has been permitted to accumulate to approximately 7.3% or 7.6% as of the evening prior to the presentation, deliberately held to provide capacity to deploy into opportunities arising from price dislocations. The fund's top 5 holdings were identified as Monadelphous, Breville, Goris, Alcoa, and Auckland International. Griffiths noted that Alcoa, whilst not conventionally a small cap, qualifies for inclusion in the Small Ordinaries Index and was given a 4% weighting upon its local listing, addressing the persistent challenge of populating a 28% materials allocation with investment-grade quality names. Structural growth exposures of approximately 14.5% to 14.7% include Codan at approximately 4%, A2 Milk, Breville, and Generation Development Group. Energy at approximately 3% includes Karoon Energy and Silex Systems, with Griffiths acknowledging a desire to add uranium or coal exposure, but noting quality constraints as an impediment. On labour market conditions, Griffiths described persistent difficulties in sourcing and retaining skilled workers across multiple sectors, with particular reference to engineering and resource industry roles. Monadelphous was cited as experiencing challenges not only in procuring contract engineers, but in managing their deployment, with recent changes to right-to-disconnect legislation limiting the flexibility to mobilise workers at short notice, previously possible over a weekend, to a minimum turnaround of Monday to Tuesday. Griffiths relayed an anecdote from a mining industry operator indicating that the number of workers required to pour 1 cubic metre of concrete on a mining site has increased from 3 to 5 over time, attributing this entirely to labour regulation rather than any change in the physical task, as an illustration of declining productivity. Childcare operators were also cited as experiencing severe staff retention difficulties. Stephen Duchesne raised the question of labour dynamics in financial services and software, with Griffiths noting that workforce rationalisation is underway across software and financial services firms, referencing WiseTech as having announced reductions of approximately 28% to 29% of its workforce over coming years. Though Griffiths noted he could not confirm specific targets for individual companies at the time. On the Australian dollar, Griffiths presented a chart demonstrating a 10-year correlation of approximately 0.8 between the direction of the Australian dollar and the relative performance of small caps versus large caps. Griffiths expressed a constructive view on the Australian dollar, citing yield differentials between Australia and the United States. Australia's position as one of only 2 developed markets, alongside the United Kingdom, comfortably above long-term inflation targets, and favourable terms of trade driven by firm gold, oil, base metal, and soft commodity prices including wheat. At the time of the presentation, the Australian dollar had retreated from approximately 71.5 US cents to approximately 70.5 US cents due to safe haven US dollar demand, which Griffiths characterised as a temporary dislocation. Consistent with the stated 0.8 correlation, Griffiths expressed the view that a resumption of Australian dollar strength would be supportive of small cap outperformance relative to large caps. He noted that whilst small caps performed strongly through calendar year 2025, the ASX 20 was up approximately 4.5% calendar year to date at the time of the presentation, whereas small caps were down approximately 10%, representing a mean reversion from the prior year's divergence. Economics. The committee engaged in a broad discussion of the current market environment following presentations from 2 external speakers covering the recent Australian reporting season. The committee noted the increasing dispersion in individual stock performance relative to the broader index, observing that this trend had been steadily rising since 2020 and was being further amplified by the growing proportion of passive investment in the market, particularly around index rebalancing events such as the transition of companies like Lendlease into small cap territory. The committee noted that while the distribution of earnings, beats and misses, was broadly balanced, market reactions were asymmetric and increasingly punitive, with companies that missed expectations being severely penalised, and even those that met consensus struggling to generate positive price responses on reporting day. The committee highlighted the divergence between domestically focused companies and those with international revenue exposure, with resources expected to do much of the heavy lifting in delivering the forecast 10.6% EPS growth for FY26. Particular concern was raised around the valuation of the Australian banking sector, with members noting that earnings multiples had expanded from approximately 10 times to 21 times, a level the committee regarded as difficult to justify given the prevailing interest rate environment. The committee also flagged the retail sector as an area of emerging weakness, with margin pressure and early signs of consumer resistance attributed to ongoing cost of living pressures. Geopolitical uncertainty was identified as the dominant near-term macro risk, with members acknowledging its potential to materially alter the inflation and interest rate outlook. Portfolio construction. The committee reviewed the current asset allocation positioning and agreed to make two modest changes to the portfolio. The existing growth/defensive allocation stood at 64%/36% against a strategic asset allocation target of 60%/40%, reflecting the committee's prior preference for growth assets. Following discussion, the committee agreed that the elevated level of geopolitical uncertainty warranted a modest de-risking of the portfolio, with the intention of moving incrementally closer to the SAA target without fully closing the overweight growth position. The committee agreed to reduce the alternatives allocation by 2%, moving from 4% to 2%, with the proceeds directed into cash. Members noted that the alternatives exposure was largely comprised of gold, and while the committee retained a view that gold had a role to play given geopolitical risk, it was acknowledged that valuations had moved and the position size no longer warranted a significant overweight. The committee also agreed to make a change within the domestic fixed income allocation, reducing the short duration position from 2% to 0 and redeploying that capital into Australian longer duration bonds, effectively lengthening the portfolio's duration profile. This decision was underpinned by the observation that Australian 10-year bond yields had sold off to approximately 5%, implying real yields of around 2.5%, a level the committee regarded as historically elevated and unlikely to be sustained given the domestic economic outlook. Members agreed this represented attractive relative value compared to fully grossed-up bank yields and other defensive alternatives. The committee agreed these moves represented appropriate baby steps given the prevailing uncertainty and noted it would maintain a watching brief on markets ahead of the next meeting.